Well, hi and welcome to your DVD training course. For those that you don't know me, my name is Martin Cole. I've been training for the better part of 20 years, and what I'm about to reveal to you really is my accumulated knowledge. Now, it's not the accumulated knowledge that's taken me 20 years to accumulate. Rather, when I first started off, I'd done pretty much what every trader did, and or does, let us say, and that is they look at the charts, they look at the patterns, they try and devise systems and strategies to actually make themselves money. And I did this for probably about 18 months to 2 years, and then ongoing research and that sort of stuff. And it took me a long time. I can't remember exactly how long it was, but it took me a long time, and cost me a lot of money to discover what it was that really moved the market, what was behind every market move. And once I'd achieved that, once I had that understanding, and I viewed the market from that model, if you like, that model of the market, then things change. Things change rather dramatically. But I won't go into all that because obviously that's my story's on the website if you want to go and read about that. But anyway, what I want to do today is I'm going to kick off with the start of this course, and we're going to sort of jump in, not at the deep end as such, but we're going to start this as if you know something about trading. In other words, you know how to buy and sell and that sort of thing. Now, I just hasten to add that if you don't know anything about that, or you're completely new to the Forex industry or in the trading industry, there will be a complete section for new traders. That'll be sort of towards the end, maybe even on a separate DVD. So basically, if you are an existing type of trader, you can start on DVD 1 and get stuck straight into it, and what we're going to do here now. If you're completely new, then you might want to go to sort of the basic DVD where everything starts from, and then come forward and start from here. Okay, so let's make a start. Now, the first thing I've got up here, there's 6 weeks to trading prison, which is sort of a bit of a contradiction if you think about it in its way, because what I'm talking about is about trading freedom, is about achieving financial freedom, becoming free to do what you want to do in life. And just as a side note there about my own situation there, I can honestly say to you, I never set out to be a trader, 20-year trader. It's not what I wanted to do. Trading for me was, I had specific goals in mind. I simply wanted to earn enough money to enable me to do the things that I really wanted to do. As it happened, I ended up spending quite a lot of years in trading, as it were. But whilst I was in trading, of course, I wasn't always glued at the screen. After about 5 years, when I really understood what I was doing and I really got on with things, I was able to move off and live in a different country in a warmer climate. Left England, went to live in Spain. And so for me, really what I'm saying is trading was a means to an end. Now, whether you want to make a trading career, that's okay, that's fine. But if you want to do like me, you just want simply to earn enough money to then go off and do what you want to do, again, that's still a great aim. But what the reason I've put this up on here is because many traders, when they start off, you'll find that and obviously you yourself, you'll perhaps discover that you can do no wrong. You sort of look at the market, you start trading, you draw up a few indicators, and you pretty much make money. You become successful. What happens though? Where does it go wrong? What starts to sort of bend things around and mess things around so much so that you get to a point where you're not making money and the whole thing turns into rather an unpleasant experience? Well, basically what happens is when you first start off, you're sort of raw, you don't know anything too much, so you simply see things in front of you. They make sense because you haven't got anything to draw from, any past history, if you like, to do with your trading, and so you act and carry out your trades. But gradually, over a period of time, you become imprisoned, and that's what happens through here. And I reckon that this happens from experience and from talking to other traders over many years, around about 6 weeks, and they end up what we call trading prison. And what happens in trading prison, or what the causes of getting into trading prison, are a loss of confidence. Now, the loss of confidence is going to come about as a result of simply getting into the market. You're making a bit of money, then you're losing a bit of money, making a bit of money, and so this cycle perpetuates. But gradually, rather than your account going up like this, your account starts going sideways and actually starts to go down. So you start to lose confidence in your ability to read the market. Now, and a loss of confidence will cause a lot of mental turmoil. You will end up with feeling confused. It's a very unpleasant feeling. You've got, I call it like the dual voices going through your head. Should I or shouldn't I? Should I or shouldn't I? Should I buy? Should I sell? Is it going to go up? Is it going to go down? So you start getting all this mental turmoil going through. Emotional issues. I've got these emotional issues down here because trading can become a very emotional experience. Now, we're going to be talking about emotion because that's quite a big issue about people trying to get emotion out of trading, and that's a sort of a trading truism that we come into later on. But I'm talking more about the emotional issues that can come. You can become quite emotionally engaged, and also even when you're disengaged from trading, that emotional negativity can sort of hang on to you as well. Relationships, often overlooked part of trading. If you're trading, you're in a relationship, you're married, relationship, whatever, you do have this other person to consider, because often what you'll find with trading is you can be sitting for extended hours in front of a screen, and you're sort of isolated, and then sometimes the question is asked, what have you done today? Maybe you haven't done anything, and it's like you haven't been working. Of course you've been actively looking at the screen, but may not have been any trading opportunities. And so relationships are something that needs to keep an eye on. And this sort of thing can also cause quite a lot of problems as well. If you're not comfortable, not happy doing what you're doing, or your partner's not happy doing what you're doing, this can cause a lot of pressures as well. Blind alleys I've got down here, because blind alleys, you can, as you start to deteriorate, or so your trading starts to deteriorate through the 6 weeks period, you can start going off and looking at other things. All sorts of weird and wonderful things that sound good at the time, or you're looking at them in terms of how they may lead you away from the situation you're in, obviously to going forward into a profitable situation. And so you often experience a lot of blind alleys, and of course these all have the effect of causing us this prison-like environment to your mind. And finally we sort of got rid of the pain, anxiety and anger, and that sort of those last three sort of build up into a culmination of a situation where it's quite unpleasant indeed. So these are all a barrier. So this barrier becomes created to the wealth and success that you actually want from trading. Now, of course, I quite realise that wealth for some people is quite different from another, and that's your own. We won't go into that. That's really, wealth and success is for what it means to you personally. Okay, so what we're going to look at now is the barrier and what actually causes that barrier to arise. Okay, the barrier is actually created by market perception, your perception of the market. And the perception of the market is gradually, when you get to around this 6 weeks period, is that you need to remove this emotion from your trading. And the reason you get to that point is because most all the chat rooms and the forums and everything else are saying to you that it's emotion that causes the problem. You've got to get this emotion out of your trading, and that will resolve the issue. And that's a perception of the market that is entirely wrong. You're never going to remove all that emotion from trading. Let us say you're never going to remove all the emotion from trading. You don't want to, because part of that emotion is good emotion. You want to be feeling good about what you're doing. You want to feel good about your trading. So emotion's a great thing to have in your trading when it's in a positive form, and that's what this course is about: is getting you into that positive frame of mind. Now, and of course successful. And so the perception is they want to remove this emotion from your trading. Now, another thing is mechanicalized system. The perception is that if we create a mechanicalized system, then we're completely disjointed from what we do. We can create a mechanicalized system. The computer can tell us what to do. We push the button, or even the computer pushes the button, and then it trades off and deposits automatically money into our bank account. Now, that's a utopia, and that's of course a lot of things that's sold with that concept today, and that is a complete fallacy. But we'll get more into that later on. Okay, so mechanical systems will then be looked at. And also the perception is that trading technical analysis skills, if you develop more technical analysis skills, the perception is you'll become a better trader. Now, I can tell you that I've met a lot of traders throughout my years. Some of them have been what they call fellows of the Technical Analysis Institute, people like that. And these people know absolutely everything there is to know about technical analysis. Unbelievable huge amounts of information that they hold, and they can reel off indicators and everything else. The acid test is, of course, do they make any money? And the answer is many of them absolutely do not. And I've yet actually to meet one who has made consistent money. So technical analysis skills, the more technical information you get, the perception is that it's going to make trading easier for you. And the last one down here, we've got a personal system. There'll be a lot of people who say to you, or a lot of information we receive, that you need a personal system. You need a personal mechanicalized system that will remove emotion, and you can develop this with trading technical analysis skills. A personal system will be something like, people would argue that it takes in consideration your aversion to risk. It factors in what you perceive to be a threatening environment or a non-threatening environment. Something that cycles around you as an individual. And of course that also sounds rather good when you think about it, because it's saying, okay, well, this is a bit away. This is a wide sort of area here. It doesn't really apply to me. But if I take this and I make this as a personalised, tailor-made trading solution for me, that's got to work. So again, the perception of this is, by putting all these together, you will overcome or remove this barrier. Now I've got down the bottom here this big word down here, absolve. What this is actually all doing here, the perception is that if you get this done here, this will absolve you. You will be free, you will stand back from your trading. In effect, you'll be absolved of responsibility. And you'll often hear traders who say something like, my system told me to buy and I bought, and that's it. And you can ask them, well, but if you knew it was not going to do it, why did you do it? Well, my system told me to do it. It wasn't me, it was my system. I'll get back and tweak the system, as it were. So basically, all this is absolving you from the responsibility. Or that's the perception, that it is absolving you from responsibility. Okay, so let's have a look over now and see what perception actually does. Well, the perception of trading actually places you in jail. That's exactly what it does. It locks you away. If your perception of trading is that you need the mechanicalized systems, you've got to have no emotion, all those things have got to be done, you've got to stand away from it, that will actually place you in jail. And what will actually happen once you're in jail, after your 6 weeks, or obviously you can go on longer than that, what will actually happen once you're in jail and you've been starting to do all this stuff and you get a little bit more information, you're starting to develop strategies, what will actually happen, you will get into this, what I call this losing loop, okay? And the losing loop literally will start off that you will sort of have a bit of a strategy. You'll develop a strategy, you'll work out some moving averages, and if you don't know what a moving average is, if you're quite new, that's just basically some moving lines across your chart, and you'll work out when they sort of cross that then you should do, this will mean this, and then you should do that. So basically you will develop some type of strategy that will involve you or the chart showing you something and then you taking some action. And what you'll do is you'll play around with this strategy until you find that it produces a successful result. Of course, once you start getting the success, you'll likely paper trade this without any money. You'll sort of put it in, you'll back test it and find over years how this has produced a huge amount of money, and you'll become very excited about this, and you'll be ready to get into the market. And what you'll do is you'll then go live and you actually start trading this live. Now, generally at this point, what you've done is you've caught a cycle. You've identified a nice cycle. You'll start putting money in this. You'll go live, and you may experience a couple of wins, a little bit of winning. And then what will happen is you'll discover that this actually starts to failure. So on paper, this looked very good. Everything worked very well. But we actually start getting into failure. It starts losing. You start losing a bit more money. The cycle starts to change. Then what happens is you then develop. You go back into what's known as the development stage. The development stage is where you go back to your original strategy and you tweak it. You mess around with it. You adjust the parameters. What you do is you adjust the parameters and you convince yourself, yep, this is now good. You're back at the strategy development phase. This is now good. I'll now back test this. I can now see over so many years this has produced X amount of money. You'll see it experiencing success. And once again, you'll go back down and you'll start going back in, going live. I don't need to go any more from this. Once again, you'll go back into the failure, back into developing, back into strategy, and so you will get caught up into this losing loop. Now, how long can this go on for? I have met traders who've been trading in excess of 10 years and they are still in this loop. They will openly admit they have developed thousands, literally thousands of trading strategies. They've become highly educated over the years in technical analysis, all sorts of information like that, but they're still in this loop, going round and round, this endless loop. It's a bit like, I say the definition of madness is to keep doing the same thing over and expecting different results. This is exactly what we're faced with at this rate here, getting into this losing loop. So what you need to escape this, you need a get out of jail card. And the get out of jail card is what these DVDs are about. The get out of jail card is understanding and trading the market makers' three phases. Now, most of this DVD course we're going to be talking about the three phases, because this is what this is about. By understanding the three phases of the market, as your get out of jail card, you are going to break that the cycle that we looked at on the previous slide there. And the three phases are: we have the setup. Okay, the setup phase, we have an accumulation phase, which is sort of linked into there, and then we have a profit release phase. So just recapping on there, we're going to understand the three phases, the market makers, the business makers model, and the three phases of that model. Okay, now I've been talking for a little while now and sort of presenting this up and showing you what you're going to be doing, and the get out of jail card and the losing loop and that sort of thing, and we're looking at these three phases. But let's face it, talk is cheap. And it's all very well me standing here and saying, well, this is what you're going to do and this is how it's going to work out. What you actually need is proof. You need proof that what I'm saying here works in the real world. You need the acid test. I call it the acid test. We're familiar with that term. So what we're going to do now is we're going to go over to the computer screens, which are just over there. You're at the back end of my office now. We're going to go over to there where the computer screens are, and we're going to see if we can set something up and get trading. We're going to have a look at the markets live, and it won't be quite as fast paced as what we've gone through here, because obviously we'll be looking at live markets and we have to wait for certain things to occur and trigger off. But we're going to have a look now, and we'll get this in motion so that you can see how this plays out and actually how money is made. So I'll catch up with you very soon. Hi, well, here we are at the trading screens. Now, what I've got in front of me is, which you can't actually see at the moment, obviously because we're looking at me, is my trading software. It's got set up on my laptop in front. Now, I hasten to add that whilst this trading software is going to look a little bit different to you, because it is different, remember that this DVD course is not solely about my trading software. I'm going to be explaining that to you later on, but for now what we're talking about is the way in which the market works and how we're going to use that knowledge to make money. Okay, so what I'll be doing is, you'll see in a moment, obviously you'll see now, once I've put the video up, that I'll be appearing in this this little corner at the bottom here, and then we'll be talking about the chart, which is the market unfolding as things go on. Now, we can currently see that we're looking at the Euro 15 minute. You can see that by looking up there, and if I left click on any of these bars, it gives me the time here. I can see this is a 7:30 bar, which is this last bar setting up here. Now, I'm particularly paying attention to around this time because in a moment the software will put on what is known as a thick bar. It'll occur around the 7:45 time, and then from there I'm going to be looking to map out the market in terms of where I can enter that market with a very low risk to take some pips profit out of that market. Remember, this is the acid test. Everything that I say, can you then turn around and apply this to the market to then extract money from the market? That is the acid test. That's it. Okay, so what I'm going to have to do on this video, by the way, of course, is pause the video from time to time because I'm recording on a computer screen. The file size is huge. Now, ultimately, this will end up on a DVD, so it won't really matter. But the more we try and record, or the longer we try and record the computer screen activity, the less stable the computer will become, and you can end up in a situation where you lose that recording. So we don't want to go through that after we've obviously gone through and set all the trade up and everything. So I'm just going to be talking you through this. So what I'm doing now is I'm looking at the time 7:30. I'm going to hold on now until I see the thick bar occur, which is going to be around 7:45, and from there I'm going to be setting something up. But for now, what I'm going to do is I'm going to use a tool that I've got in pat here, which is our 90 pip tool. Again, this gives us a 90 pip range. Nothing complex about that, nice and simple to understand. But I'm particularly interested this morning in a 45 pip range. And again, I'll talk to you about this fully when we get there. But for now, remember, This video is about the acid test. This is before we get into the lesson, before you get into the DVDs, I want to show you what I do and what you will be doing so that you can go forward in the DVDs with confidence. So I'm going to put the video on pause for a moment, with it on pause, and then when we come back up, you'll see obviously the time will have moved on, and then we'll be seeing about getting our trade set up. So I'll catch up with you in a moment. Okay, welcome back. Just left click on this chart. You can see the time is now 8, so there's the 7:45. Now you can see that bar's a little bit thicker, and again I'm not going to go into the software at this stage because that's not what this is about. This is just to show you what we've gone through so far on the board, what we're actually going to be covering on the DVD. Okay, so what's going on? We can see now that the market is going down. You can see we've got this live price, which is the blue line here. You can see 40.44. You can see this flashing 43, 41. You can see the market starting to go on down. And of course, traders are now starting to come in and starting to sell the market now. The moving averages, again, we'll talk about these later on in the lessons, but that's sort of starting to cross, and the indicators are now getting down to a point where I think the market looks like it's going down, and that'll be encouraging traders to come in and sell and join into that down move to obviously make profit by selling the market as it was down into a short move, down being the short move. Okay, so what am I doing? Well, I'm just sitting on the side at the moment, and I'm certainly not going to sell the market. In actual fact, I have a buy order in ready at around to go at 4024, which you see this bottom white line running through here. 4024. I actually have a buy order sitting on my dealing platform waiting to buy that price. So while others are coming in there ready to sell, I'm thinking about getting ready to buy this market because I am trading the market maker phases. I am not trading the image that you see on the chart. The image is just the facade. Again, we'll get to this in later lessons on the DVD. So I'm not trading the image, which is the facade, if you like. I am trading the market maker phase. I'm trading with the market makers. I'm looking at their manipulation, looking at what they're doing, and trying to work out where they are going to make their profit. Because if I can locate where they're going to make their profit, I will make money by default. And that is the type of trading that I like. That's the type of trading that I'm going to be teaching you. So I'm going to put the video again back on pause at the moment because obviously we can't just let it run and just grow big with this live price flicking around. And I'll put it back on, as we say. Now I've put a buy price in at 4026. So you can see 4024 is on this price here. And the reason I put it at 26 is because the spread on the dealer's platform, again, this is something we'll cover later on, but the spread, which is the difference between the bid and the ask, is going to be 1 or 2 pips. So by putting at 4020, if the price comes down at 4024, I can be assured that I will get filled at 26. And I want to do that especially as I'm doing this video as well. I want to make sure I get filled so that I can show you the proof of the trade and the contract note when the trade's over. Okay, so currently that's my position. That's what I'm going to be doing should the market get down there. So I'll put the video on hold and I'll catch up with you in a moment. Well, time for a quick update. As you can see, the market hasn't got down yet. So in other words, the price hasn't got down to around the 4024, 26 mark. In fact, the market's gone down a little bit and then it's started to lift up a little bit. And we're currently at 4052, 53. As you can see, and that's the live price that you see. The live price is the blue price there you see flicking around. But I'm quite content to sit now and wait and see how things pan out. Now, should the market not go down and actually start to continue to rise, then I will have another plan that I will action should the market start to go up. But again, let's just hold off on that before we get to there, because I don't want to jump in with two types of that's two types. No, that's incorrect. I don't want to jump in with two explanations at this stage. I want to see how each one plays out so I can explain it better that way rather than trying to explain two types of opposing orders as it may be. Anyway, so we'll just keep sitting on the side and stay with me, and we'll see how the trade pans out later on. Okay, quickly back this time. You can see now the market is currently 4067, 66, so marketing's lifting up quite smartly. So a lot of traders there rushing in to buy that, to join in that upward move on there. I'm actually not convinced at this stage. I think this is a bit of skullduggery, if you like. This is a bit of manipulation by the market makers. So I'm getting or preparing to join in on that misdirection so that I can then ride with the market makers and I can profit on that move. So currently I have a sell order in. This is an automated sell order, by the way, so it basically it'll be triggered as the market, should the market get up to that level. And I have a sell order in at 4076. So you can see this line's at 4078. Again, remember that little bit of a spread I talked to you about. So I'll be looking to sell the market around about the 4078 mark, should the market rise up, and we'll see how that plays out. Okay, welcome back. Well, the dealing platform was just triggered. So in other words, when I say triggered, the price went up, touched the price, and the price that I wanted to sell at, which was at 4076, and I'm now short in that, which means I'm expecting the market to go back down from here. Now I'll show you the contract note at the end so you can see the time when I went in and the price that I actually got filled at, so you can see how everything goes from there. So we'll just sit now and watch the trade and see how things start to develop, and then we'll follow up accordingly from there. So as you can see, if you look at the price now, here you can see how the next bar, so in other words 845, has gone up, and like the previous one, I can just show you my hand there, basically gone up and probed under the 78 and then come off. Now when I say come off, I literally mean the price has come off, it's come away, and I could be likewise if I was actually, if my price was coming down to a certain level like this and then touching this and then rising back up, I could also say coming off or coming away. So this is coming off or coming away. And so currently the price is dropping down. We're in the money, which means that the market price has moved lower than where we sold it, and we sold it, so we're looking to make profit on the down move there. And you can see currently 70, 72 the price is trading at, and we sold at 76. So currently a few pips in the money there. This is no reason to get excited about this trade because it's certainly not over yet. Currently I've been able to identify an area of manipulation, which is what the course is about, is showing you where this is, and then the profit release cycle, and profit release phase, and then hopefully this trade will show that we're into a profit release phase, and I'll show you how we then take the profits and then maybe set up for the second trade after that. But this video now is getting on to 10, just over 10 minutes, so I think what I'm going to actually do is wrap this video up at this level and then create a new video just in case we have any problems with this video, because I have had situations before where we the computer freezes and we lose that part of the video. So I don't want to do that now, because obviously we've got a good bit of video there to actually show you how this trade's coming out, so you probably won't even notice the gap, but if we do, we'll obviously see how we come back from there. So we'll call this a close now. Okay, a quick update. You can see now that the price has actually pushed through the 4078, and what that means is that our trade has gone out of the money. So in other words, the price is above the price that we sold it at. So currently we're out of the money. That is, we're not making money anymore, but now we're actually losing money. So the higher the market goes, we'd be actually losing money. Now, of course, there's a limit we put on that. Again, there are things I explain to you later on about how we restrict our losses. But for now, there's not too much to worry about, because currently the market's just having a little bit of a play around there, and we'll see how that develops. It may well develop into a long market. When I say long market, I'm actually referring to market then going up. It may well develop into a full long market, and that's okay, because we will then later capitalize on that. But currently at this stage, we'll just sit with it now and see how the market actually develops. Okay, a quick update now. We can see that the market's coming off again. That's what I mean, coming away from that price is going down. So 4064, 65, you can see on the little blue flashing price over there. And so currently, so far, obviously we're in the money now, we're making money, and this trade is not a cut and dried, as I say. It's not overall over yet. We obviously want to exit this trade to actually take our profit, and I'm planning to exit the trade around 4033 price there. Now, however, this market could indeed start to pick up a little bit of strength. Now, what I mean by that is, again, without getting too technical, because this is going to be fully explained to you later on, is the market could indeed find a little bit of strength, run into some support, and that could happen about halfway through this green block that you see here, this green block on this level here, and it could develop a little bit of support there. So we'll just see how that develops, and that will then tell us the story of what we need to do. Again, this is all explained as part of the training. Again, what I'm trying to do here is just simply show you that this is what we do and this is how we make money. Okay, time for a quick update. Certainly dragging on a bit, this one, and you can see anticipated we might get a bit of support around halfway back down through the green. You can see we've got a bit of support there, Again, not going to really get into this because again, it's just showing you what we do. That's all this is. That's all this trade is about. But you can see it's picked up a little bit of support there. And now really for this market to collapse down or go down, I say, it's got to really break through this level here, which may well go back up and have a little probe. You can see around the 78 mark or even break above there and then move on. But we'll see how that develops. We can't do anything other than wait for that to play out and then we can act accordingly. So we'll sit on the side and I'll update you when things happen. Okay, back to have another quick look. We can see indeed the markets have come away again from the 4078, which is on this bar here. You can see the market has come back down. And the exit we've got planned at 4033 is not looking too far away. Moved the stop loss down. Again, I'll cover this later on in the video, sorry, on the DVD course, where we use stops and what settings we use, etc., etc. But currently I've moved the stop down to 4086. Remember we sold at 4076. That actually leaves me 10 pips on risk. Now as the market comes down closer to 4033, then I'll shut that down even more. So I'll get into a no-lose situation. And we're not too far off the 4033. That should actually make it down there. And we'll just see how that goes and I'll update the video and how things progress. Okay, I just moved my stop down to the entry position. So in other words, remember we sold at 4076 and I've now got a stop down at 4076. So I'm into a no-lose situation now on this trade. And you can see that our exit's still out at 4033. Hopefully this will be traded to in the not too distant future. And then we can bring this video to a close and move on. Okay, a quick update. It's getting pretty late here in New Zealand. And so we're getting up to, well, we're 25 past midnight, so really am sort of struggling on to stay awake for this one. It has taken a little bit longer than it normally does. Normally this would be over by now and we'd be out with our profit. So what I've done is I've moved the stop down to 66. I've locked in 10 pips. The reason I did this is because the market's very close. If you can click on that, the low of 38, and I'm looking to come out at 33. Okay, so the market got very, very close to that. And I don't really envisage the market going back above the 66, so it may well do that, and of course we'll just get 10 pips out of it, which will be a bit of a shame after having nearly got so close to the target, as it were. But I'll give it a while longer because we're not that far off, and indeed we could see that market come down to the 33, and we'll bank those profits. Thank you very much. So I'll hang on for a while longer and update you as and when. Okay, I was just turning away there and look back and I can see we've got a bit of activity, and price is down now at 37.39. That's the sell and the buy price. So we're looking for that to get down to 33. So what I'll do now is to move the stop down even tighter at this stage, because obviously the market's been down to that price there and it should carry on down. So let's just move my stop down to say 56. So I'll just do that now. Okay, stocks moved down to 4056, and you can see that's just under that red line. You can see there. That's not why I've actually moved it to the red line there. I've moved it there because if you look at the low on this bar, you can see down 4034. I've got an exit at 33, and it hadn't quite triggered that, so it didn't actually go down and fill the price. So it hasn't taken me out at my desired profit level. So I've moved the stock down. That's now locked in 20 pips, and I've got to left that. I've left it the opportunity to go down below and still fill the price, in which case if it fills that price then we shall make 43 pips on it, which would be much better than making the 20. But either way we can't lose on this trade anyway. So I'm going to hold on a little while longer, even though we really are getting on late now. It's 1:15, it's 1 AM here in New Zealand, so I'll hold on a bit longer and see if we can just close this off and wrap everything up to finish the video up. Okay, you can see the market now has gone down again, almost to the 33. So what I've done now is move the stop down yet again, down to 46. That locks in 30 pips for us. And I'd be very surprised if it didn't actually get down and go through the 38 now, but it doesn't really matter now. We've got 30 pips locked in. It's been a great trade, and we'll see how it finishes up. Okay, and there we go. It's just about 2 minutes to 1 AM, and you can see the market's now trading back through to our target, which is 4033. So we're out with a a very nice, healthy plus 43 pips. Now, just before I finish this up, there's a couple of things I want you to take away from this video. This video was just to show you the acid test, if you like, of what I've explained to you so far. This is what we do. This is what the DVD set is about. This is what you're going to be learning. So whilst you've looked at the chart today and you've seen the market and you've seen the bars and all that sort of stuff, that is just the facade. That is what's presented to us as a facade. And what I'm about teaching about is what's going on behind. So in other words, if you think about this, I was able to place the sell order at 4078 way before the market got there. So how did I know that? How did I know that the market was highly likely to turn down from this area? Now let me just get a marker on here so that we can talk through this. So how did I know that from here the market was highly likely to go down? Secondly, how did I know that this area here was the market where it was likely to reach, thus giving me 43 pips profit on this trade? So how did I know this? How did I understand this? Well, there was no chart pattern here that told me this. What told me this was the 3 phases that you were going to be learning about. Once you've got those 3 phases now down, then this becomes a completely different ball game. Trading becomes a much simpler process because you're looking at what really moves the market. You're looking at what's behind that. So in other words, you think about this is the form the chart takes. We're going to be looking at the content of the market. Okay, so I'm going to bring this video to a close now. I'm going to get these screen drawers off, bring this to a video to a close, and I'm off to bed now. And I hope you've enjoyed this, your first sort of look at the live markets. And we'll be doing a lot more of this as we get on. So have a truly great day. And I'm saying that day because obviously in Europe, maybe if you're in Europe, you'll be wide awake lunchtime. And we'll catch up with you first thing in the morning to carry on with your course. Well, welcome back. I hope you enjoyed our live trading session. Now, of course, it took quite a time to get through. It was sometimes, people think trading is sort of a fast-paced, active, exciting sort of business, and it can be like that. But in reality, of course, you're waiting around for the right situation to occur to spot these market maker phases. You're then setting your trades up and then waiting for those trades to plan out. And sometimes those trades can be over in 5 or 10 minutes, but sometimes they can take 5 or 6 hours. It might take 10 hours for that trade to play out. And of course, it doesn't matter in one respect because, of course, we don't have to be there all the time watching this and waiting for this to play out. Once we've got things set up, which is very much what we do, and once we've got our exit targets planned, then we can set this up and then we can leave away and just come back and monitor. And sometimes we can just leave it completely and let the trade run out as we expect the trade to run out. But more of that later. Okay, so what I want to talk about now is getting back to our market makers. I want to talk about in order to make money, and I'm going to start off with some sort of obvious things here, but in a way they do need close scrutiny or consideration, if you like. And the first thing I want to talk about is motivation. The absolute motivation. There's got to be motivation to make money. And remember, I'm not talking about us at this stage. I'm talking about the market makers. What is their motivation to do what they do? Okay, to carry out the business, to do what they do. Their motivation is profit. There is an absolute need for profit. That is their motivation. And just imagine you've got these huge city tower blocks. These don't run on their own. They don't run on fresh air. They cost an enormous amount of money to run. The salaries, everything else that goes into the financial institutions that make up this whole money pit, if you like, everything. There's an absolute need to produce profit on a moment-by-moment basis to fuel this huge empire. And in order to make money, we've got to have repeatability. So what they do, or what anybody does, if you like, if you're going to make money over a period of time, you've got to have a degree of repeatability. You've got to be able to repeat what you do. If you have a successful business, whether you're selling bananas, you've got to have this repeatability. If nobody ever ate bananas, nobody's going to buy bananas. So we need to have the repeatability of the business. And to get repeatability, there's got to be a money supply. There's got to be money there, constantly turning over to enable the repeatability to take effect. And thirdly, there's got to be a system, to make money. In order to make money, there has to be a system, there has to be a structure, there has to be a business model. You can't just go into business and say, I'm going to I'm going to produce X, Y, Z. I'm going to produce sunflowers, for example. I don't know where sunflowers came from, but I'm just thinking, I'm going to produce sunflowers, for example. There's got to be a system. There's got to be a system of planting and harvesting and whatever you're going to do. And you're going to produce the seeds, you're going to produce oil. There's got to be a system. And that system will have a sequence of events, just like planting a sunflower. We'll have to go through a planting time and harvest, etc. There'll be a sequence of events. And these secret events are vitally important. So in order to make money, there's got to be the motivation. We've got that, the profit need. Repeatability, there's got to be a money supply there. System, and there's got to be a sequence of events. So let's just have a look now at the sequence of events. And the sequence of events that market makers run through are very simple. It's a simple business. And now I hasten to add here, when I say it's a simple business, the market maker's business model is a very simple business. It has to be. You couldn't run something as complex as the financial markets with a complex system that was liable to break down or whatever. The actual process of making money with the market makers is this very simple three-stage process. Now, in the acts of buying and selling, we actually have what is called an accumulation phase. Now, you can see I've got ACC up here. I've just shortened that to save me writing out accumulation right the way across the board there. So we've got this accumulation, and this is one of the phases here. This accumulation phase, which is the first phase of the cycle of events. The second phase is manipulation. And the third phase is the profit release. Now, I will be breaking all these down for you piece by piece. So first off, we've got to go through this accumulation, understand what this is, we understand what the manipulation is, and we understand what the profit release is. When we understand these three phases, and we can identify those three phases, we can join the market maker's business model. So let's have a look now at the process of profit. How is profit made? How do the market makers actually make profit? Okay, so the process of profit is, in order to make profit, you've got to, if you're going to buy something in and sell something out, and you want to make money in that respect, so in other words, we buy and then we sell at a higher price, we've got to be able to accumulate. We've got to have something first in our possession to then sell on. Now, a little bit difficult to explain in some respects, especially with the sell side, of course. When we're speculating on markets, and we're talking about the Forex market here, but any market indeed, when we're speculating on markets like that, unless we're actually physically buying shares, accumulation shares or stock, we don't actually own anything. Nothing is actually given to us in paper, as it were. Now, we are really just speculating on price difference between now and what it might be in the future. Is the price going to be higher, in which case we want to speculate on higher prices? Is the price going to be lower, in which case we're speculating on lower prices? People have a job getting your head around the short side or the sell side, but we'll go through that piece by piece to make sure you understand that. But basically, it is a mirror image of the upside. Okay, so in the process of profit, we've got to buy something. Now we touched on accumulation. So you've got to accumulate something, okay, to then sell later on. So in our case, what we're actually accumulating, think of it as buy orders. And if you want to physically give it something, think of it as slips of paper. Just think of anything that'll put it into your mind as an image. We need to accumulate what's known as buy orders. If we're going to accumulate buys to sell later on and profit from those at a higher price, we need to accumulate buy orders which will sell later at a profit. Likewise, if we're going to sell the market, we think the market's going to go down in value, we want to accumulate. Yeah, we still want to accumulate. We want to accumulate sell orders. In other words, little sell bits of paper. That's what we want to accumulate. So we either accumulate buy orders or accumulating sell orders. And this is the market maker's model, remember, not us. We're doing the same sort of thing, but I'll get to that later on. So you're either accumulating buy orders or accumulating sell orders. The market makers are. In this case, they're selling to buy. In this case, they're buying to sell. Okay, now so we understand that we've got to have that accumulation. We've got to have that stock before we can do anything from there. Okay, so accumulation of the buy or sell orders. If the market makers want to accumulate buy orders and everything is matched in the market, so if I buy, for example, somebody else is selling, so we're selling, we make that exchange, and if I sell, somebody else is buying, everything is completely matched in the market, okay? So let's suppose that I want to buy something from you, I've got to convince you to sell it to me. And if you want to buy from me, you've got to convince me to sell to you. Okay, so this thing here is conveniently matched well is vital to understand. There's no load of buys here without sells. It's all completely matched. So in order for the market makers to buy, someone has to sell. Very important point there. Very important to keep that in mind. Someone has got to be willing to sell. Now, why is somebody willing to sell when the market makers are buying is a whole different thing, but we'll get to that in a moment. Okay, and if of course the market makers want to accumulate sell orders because they anticipate or they know that the market is going to go down and they want to accumulate sell orders to profit on the way down, who's buying? They've got to convince someone to buying. Now we hear a lot of traders talk about the market's overbought or the market's oversold. That's a complete fallacy because everything is matched out. Nothing's ever overbought, nothing's ever oversold. There's only people's beliefs about whether they're willing to buy or whether they're willing to sell. They might have stronger beliefs one side of things, but everything is going to be matched. Okay, so what I want you to draw from this is about when you're looking at this so far, is think about this, think about all this going on, buying, who's selling, who's buying, and then I want you to consider something. And that something is that this business is not about you. It's got very, very little to do with you. This business is not about you making money. It's not about me making money. And when you come to that realization, you will have quite an intrinsic understanding of what's going on without even having all the information yet at this stage. But hopefully you'll start to think, hang on a minute, this is an industry here. And this is not about me being a trader, okay? This is not about you making money. This is about the market makers running a business. So everything we've talked about so far, accumulating the buys, accumulating the sells, and all that information we've covered so far is all about the market makers running their business. Their business. This is not you trading. The purpose of the business, we know what the purpose of the business is. The purpose of the market maker's business is to produce profits. That's it. It doesn't go beyond that. There's no altruistic here. There's nothing for the good cause of the planet, whatever. This is about making profits. Okay, and important, this bit down here, very important, you are part of their business. Okay, their business model, you're part of it, and this business model could not exist without you. Very important. Just really understand this. If we could encapsulate everything really that what I'm going to be teaching you over these coming lessons, if we can encapsulate that anchors into your mind. This is probably the single most important piece of information that I can impart to you, is that this is not about you making business. This is a business model that exists without you, and the purpose of the business model is profits, and you are part of their business. Okay, so at this point you really have you get to choose one of two paths. It's as simple as this. You're going to go down one route, or you're going to go down another. Which route are you going to take? Two paths, two routes. Okay. Most traders, and I've got these percentages up here. These are roughly around about the right percentages. 95% of traders believe that trading is their business. It's what they do. They're the traders. They're in control. They trade the market. It's their business. Okay. These traders view the market from the outside in. They look at the market from the outside in. They observe it. They observe what's in front of them, and they trade that as their business. The other 5% understand completely, intrinsically, that this is not their business, but it's their business, the market maker. It's over there. It's their business model. It's the market maker's business model. And they come to appreciate that by accepting that and by working with the business, with the market maker's business model, they will achieve success. They don't care about themselves running a business. They don't care about whether they're the ones that proceed. They're not saying to anybody that I'm a trader, it's what I do, it's my business. Yes, they may carry out the act of trading, but they're carrying out the acts of trading relative to the market maker's business, not relative to the facade on a chart or a chart they see. Every trading action is relative to the market maker's business. They're like the limpet that sticks on the side of the whale cruising the oceans, if you like, or the liners cruising out, the limpets or whatever it is, that the barnacles that stick on the side there. And that's what they are. They attach themselves to the market maker's business model, and that's how they actually achieve trading success. Okay, so let's have a look at the market maker's business model. Basically, a very, very simple business model. They need accumulate, again I've ACC just to shorten that up, accumulation. They need to accumulate to sell higher. Okay, they need to accumulate to buy back lower. It seems like a sort of a confusing thing when you read this through. So just have a think about that for a moment. And that's nice and easy to understand. Accumulate to sell higher, so you get something in to sell it higher, or they need to accumulate to buy lower. It doesn't make sort of sense, but it does make sense because that's how the business works. You accumulate something to sell at a lower price and buy it back. You buy it back at a lower price, and you've profited from the price difference. So, okay, so basically we can see that they create a circle. There is a circle of selling, and there's a circle of buying. Now, you might think that I've written these in the wrong places, because is buying down, selling up. It doesn't sort of look right as it should be, not as in our minds. Now, that's because we're now viewing this as a market maker's business model, not our business model. If it was our business model, we need to be buying on here and watching this rise up. But of course, we're looking at the market maker's business model, which is what we're going to be trading. Now, in order for the market makers to make profit, and they need to sell at a later date, when the prices are falling down or manipulating this down, they need to be thinking about buying through this period here, ready to sell back in here. Now, we'll get more into this part at the moment, but of course, as they're selling into there, you might say, well, who are they selling to? Well, of course, they're selling to the outside masses who are actually seeing the market start to go up, and they're releasing or selling those buy orders that they bought earlier, and so they release profit. Now, I've only just touched on that at the moment. We'll get that fully covered as we get later on. And the 95% of traders out there, the 95% that we looked at earlier, they are fueling, or they are part of the fuel of this cycle. And of course, throughout this cycle, we have there the word manipulation. This is all being manipulated as well. Okay, so let's have a look now at your required business model. What is required of you? What is your business model going to be? Okay, your required business model. You need to have complete and intrinsic understanding of the market maker's model. That's what this course is about, is giving you the understanding of the market maker's model. If you wanted to take over any type of business, or you were going to buy a business, forget about market makers and trading for a moment, if you were going to go out and buy a business, you would be pretty foolish to not understand the mechanics of that business. So let's suppose you were coming from buying a baking business, baking bread, and you might be coming from some other type of background. For you just to go in and arrive on day one without fully understanding what you were doing would be complete lunacy. Now, you may have turned some bread out, but whether or not the business will succeed or not, no. So you'd need to develop an intrinsic understanding of all aspects of baking bread, and I'm sure that's a very complex business, many different types of things they get into, but you would need to understand every single component of the business before you could actually start getting in and running that business and develop it and grow it. Okay, so what we don't want to do here is have knowledge of the market maker's business model. Okay. Now, secondly, we need to understand have the ability to interact with that model. It's all very well having knowledge of a model and understanding how that works. It's like we could have carried on with this course instead of doing the acid test, which is only one, of course. We've got another one to do, and more to do as we go on, more live trading. But it's all very well having knowledge of how this works, but unless we have the ability to interact with that model, then it's futile. What can we do? Say, oh yes, I understand how the market works, but can you make any money? Well, no, but I understand how it works. Well, that's not the goal. That's not going to solve any purpose. We've got to have that ability to interact with the model. Okay, so how do we interact with the model? Well, we've got the same cycle. We can see the market makers are buying, the market makers are selling. What we need to be doing at this point here, we need to be selling at around these areas here, and we need to be buying at around these areas here. Now I'm going to show you exactly how to do that, okay, because that's one of these things when you draw up the chart like this, that's a knowledge of the model, that's just the knowledge of the model, but we need to have the ability to interact with that. So yes, we're going to get to these points, and you'll see these on the live trading as we go through anyway. But we need to be selling here, we need to be working, if you like, with the market makers model. So we spot, for example, the market makers buying, going into their buying phase. So they're accumulating. We spot that, whether they're accumulating sells or accumulating buys. We spot that. Now, of course, what they're doing here, of course, they're accumulating sells as the market goes up. Okay, and then the market goes down and they start to sell the market and they profit from that, and so on down. So we need to be actively engaged, attach ourselves onto that onto this cycle, which is the business of the market makers model. So let's just have a bit of a summary at this stage, because we've covered a tremendous amount of material. But the great thing is with the DVD, of course, you can just press the button and zip back. You're going to see. Okay, so in summary, then, basically, inside and outside, we can look at this business from the inside and the outside. If we're looking from the outside in, we're just seeing the charts, we're seeing the facade of the front end of that business, and we're not looking at the market maker's business model. We're looking at something that's presented to us, an image that's presented to us in front of us on our computer screens, wherever we're looking at the market. So we're obviously going to look at this business from the inside. Now, we understand already that this business is not complex. It's not a tough business. It's not hard to work out. It's about buying low and selling high. It's about selling low, selling high, and buying back low. That's what it is. It's a circle, and it's about making profit. Okay. So when you think about this, there's another thing which we'll get into later is when we're looking at actual charts. We ask ourselves, how are the market makers going to make money from this? What we're seeing on the chart. How are they going to make money? Now you can see the difference there. If I'm looking at a chart and saying, looking at this chart pattern, I see this chart pattern that's called this. I can ask that question, or I can say to myself, well, looking behind that, get behind the side, pull back the curtain, have a look behind, and ask the question, based on the market maker's business model, how are they going to make money from what I see before me? And just by asking and then being able to answer that question, you are going to achieve trading success. Okay, we understand this is not our business. Okay, not our business at all. It's the market maker's business. We are attaching ourselves to this business. And finally, part of the summary, we know there are specific rules, and these rules are accumulation, manipulation, and the profit release phase. You have to accumulate something. In order to do that, you're going to have to manipulate it, which we'll get into, and then finally becomes the profit release phase. Okay, so let's have a look now at some phases. Let's have a look at the setup phase that the market makers go through. Okay, so the setup. Now, the setup is involved in here. We're going to have, just a note here, I'll just cap these off so you can see these. I've put ACC, which is accumulation. It saves me writing these things all the time on the board. BO, buy order, SO, sell order. Okay, so just abbreviations on there. But I want to talk about the setup, and so I can just focus on by just putting the little letters as opposed to writing the whole sentence on there. Okay, so if the market makers want to accumulate the buy orders, so they want to go through an accumulation phase, you will often find you will find that the market will go through a move like this. In other words, the market activity becomes compressed. It comes wedged down, if you like, and elongated. And what's going on in here, there's the prices, and I've simulated this with the red line you can see going up and down. The prices here going up and down in a confined range. Okay, and going through this phase, as this is manipulating, going up and down, there's a lot of manipulation going on here. The price is kept fairly tight as the market keeps cycling up and down, no real direction in the market, nothing is given away. Now, in order to enable us to do this, let's supposing that we were the market makers and we were doing this and we wanted to accumulate buy orders in this case, in this area here, in this box. Now I'll often refer to this, so keep this in your mind. When I say I'm talking of the box, this is what I'm referring to, this area where the market goes through like this. So if we wanted to actually buy and accumulate buys, and a lot of buys, what would we have to do? What would we have to do within that area there to enable us to accumulate buys? Well, very simple. As we know, each side is matched to buy and a sell, so someone's got to be willing to sell. We would have to create belief. We'd have to create belief in the outside masses, the outside market, that it was going to go down. If we can create the belief that the market is going to go down, what are these traders more likely willing to do? They're more likely to sell in preparation for that. And of course, as they start to sell into there, the market makers are accumulating the buy orders. So each time maybe the market dips down a little bit, somebody says, yep, I think this is going to go down from now, I'll sell. The market maker buys. So again, everything's matched. It doesn't become unbalanced. It never becomes unbalanced. Very important that. It's balanced all around, but one party is able, the market makers are able to accumulate the buys ready for the anticipation. So of course going through here is accumulating the buy orders. Also we're getting this manipulation. Now there's manipulation up here as well, which we will get to, because that's a sort of a different phase that we're going up through there. Here we're talking about the accumulation phase and the manipulation phase. Okay, now just again briefly, I just wanted to show the downside as well. I think it's quite important to show that, but we can get through this one quite quickly. Okay, so this is accumulation of sell orders. So again, what's going on? This is the box through here. The setup period is going through here. The accumulation phase. Here they want sell orders. As the market's going up on here, the manipulation, they want beliefs created in what? Beliefs created in the market is likely to go up. If the outside market have a perception that the market is likely to go up from here, they will be willing to sell. So they'll be willing to buy in here, so the market makers can sell out to them the orders in the anticipation, so the outside market have in the anticipation that the market is going to go up, when in reality the market makers know the market is going to go down. Okay, so and again, it's about creating a belief. Very important, that word. It's about creating belief. Just as a thing here, I'm going to mention this now. It's sort of something as we get into later on, but I want to mention this now because I think it's very, very important. This word belief. This whole box is not to be considered really as prices as such, on the manipulation of prices, I should say. This area is the manipulation of beliefs. Now think about this. In order to get somebody to sell to you, if you want to buy, or to buy from you if you want to sell, they've got to believe. And they've got to believe, if they want to buy, they've got to believe the price is going to go up. Nobody is going to believe the price is going to go up and then say, well, I'm going to sell it. That's not going to happen. It's not ever going to happen. Now we're going to be doing quite a lot of work on that word belief, because you'll understand that once you start reading beliefs in the market and how it's the beliefs that are manipulated and not price, then you really start to get an understanding of the market maker's model and what we're doing here. Okay, so there was a bit of advanced stuff there, but I just thought it's worth mentioning that now, because I want you to keep that in the back of your mind about that belief, as it were. Okay, so next we have is the execution. The execution is really the profit release. It's after you've done this. It's after you've accumulated this. You've accumulated all the buy orders that you want. You've then got to get into the next phase, which is the profit release. And what happens? How is money made? How are the market makers now making money? So once the profit release, once the accumulation has occurred, let's see the market in this case breaks onto the upside. Okay, and then we can see the market comes off and the back, and so basically the market starts to rise up, and invariably we get these, what I call these drop backs or retrace. It doesn't matter what you call them, drop back, retrace is not important. So what's going on here? Well, the market makers now have the accumulated buys. The market starts to be marked up. As the market starts to come up, the people looking at the charts, the surface people, they're looking at the charts thinking, oh, now the market's going up. They can visually see. So now the market creates a belief in the traders' this market is now going up. They are now willing to buy. So as the market starts to go up, they're willing to buy. And what are the market makers doing with what they've accumulated here? As the market rises up and the outside traders come in, willing to buy, the market makers are selling. They are now selling that which they bought at a lower price. They are selling into the rise, selling into a rise, and they are releasing profits. And incidentally, through here, there will be an average price. And that average price they've paid might be, say, in the middle of that area. It might be. The very moment anything is sold above that average price, they are making money. Even if they bought some orders here and bought some orders here, once they get above that average price, they're into making money. That's often why you will find when a market does make that initial first move, it's quite a sharp move and a quick move away to clear that area, and they can get into a profit release phase straight away. Now, I see these little dropbacks on here, but I'll talk about those in a moment when we get back to them and what's actually going on here. But that is how we get into a profit release in a rising market. I just thought it was worth putting this one up as well, so we can see again the same situation here. So the market then obviously accumulating sell orders, and then the market starts to go down, and obviously the releasing profits are buying back at a lower price and releasing profits that they've got from accumulating the sell orders. Now, just as a point here, I want to talk to you very, very quickly about a sort of trading truism that you might have. You might have heard this, or you may even be starting to think about this at this stage. You may even be thinking, well, hang on a minute. This area, this box, that's all very well. I can see how that works out. And I can see that if they're accumulating sell orders, the market's going to go down. If they're accumulating buy orders, the market's going to go up. But you don't know. You don't know. You're never going to know what's in that box. Now, people may say to you they do, but they don't. It's an after the effect thing, because you can never tell. I've been trading for 20 years. I do not know for certain what, there are clues, but I do not know for certain what is in that box. Okay, if I knew that, then the whole game would be over. If ever that was revealed, the whole game would be over, and trading wouldn't exist in the way it does. But you may be already thinking, well, hang on a minute, I can see that on there. So the logic here is very simple. Let's just place the buy order above the box here. Let's place the sell order below the box here. Then if the market goes down this way, we'll fill our sell order and we'll make money on the way down. If the market goes up and it breaks through the buy, we'll buy the market automatically and the market will rise up. We can set these orders up automatically on our dealing platform. It's great. Well, that's a trading truism. That's one of those things. That's the facade thing. That's one of those things that sounds so good in practice, in theory, and a lot of people will try and develop strategies about this. And it's called it's breakout. It's what I call breakout trading. Literally, it's self-explanatory. You get a confined area, and as the market breaks out, you trade with that. Now, I'll explain to you why that's a deadly game, which will cost you a great deal of money later on. But that's a trading truism. So keep that in mind when you see things like that and you start to think, oh, I can understand that. It's very simple. We can just put a buy or sell into there. Okay, so what I want to do now is have a close-up look at the cycle. So what's going on within these accumulating buy orders, accumulating sell orders. Now, big cycle, mini cycle. Earlier on we looked, and we remember the drawing we had here when we said about the accumulation of the sell orders, accumulation of the buy orders, and we had the market maker's cycle going around here. And then over here I've got a little one, just the same, but just a little one. Okay, just the same process on there. And I said to you I would talk to you about the dropbacks, or the retraces, when a market breaks away and gets into its move. Now, what I've done here is not a very good circle on this bottom, not a very good circle on this bottom one here at all. But what I've done is, you can see, we've got, again, this is the larger circle here, which is the one we're looking at here. And then each one, as we can see in this area here, we see these dropbacks, these retraces of what we're actually observing here, which is, again, exactly the same process that is going on here. So why would this happen? Why do you have these retraces? What's going on here? Well, first off, we get the breakaway. So we see the breakaway at the bottom here. We get the breakaway, the market starts to go up. What are the market makers doing? The market makers are now pushing out to the demand. So the outside market are coming in to buy. Market makers are pushing out those and releasing profits. And as they do, they push them out, push them out, push them out. And then eventually it will sort of overwhelm that coming in. For the speed overtakes and the outside market drops off a little bit. And so what happens is the market peaks and starts to drop back a little bit. Now, What some people will do at this stage is think, that it's not going any further. That's as far as it's going to go. Maybe a little area over to the left here, whatever they say, yep, it's not going to go anymore. They can see it dropping down. Now what they will do at that point is they will start to sell the market. The outside market will sell. What do the market makers do? It's absolute gravy. It's immediately they will accumulate more of those orders because they know that it's going to go higher. So as the outside market starts to sell, they actually buy some more stock at this point here, ready to sell into the next rise before the cycle is repeated over and over again. And that is why we see these drop backs when we see a market going up. That is what is occurring. These mini cycle processes through here, and of course there are obviously some people taking profits as well. That is an outside traders taking profits, but that's what's occurring, that cycle as we go up. And just the same as the market's on the way down, so we see the market going down. As it's going down, we see the market lift up, so people think, yeah, it's not going any further. They start to buy the market, again the market will sell and accumulate more sells for then moving on down. So what we actually have is the bigger circle here, we have the little circles within circles there. So circles within circles, the whole business model, so the actual business model that you're seeing here is a miniaturized business model that runs actually right the way through each section of the rising market and the falling market. I told you this business is I told you this business was a simple business. It is a simple business. It's about accumulation, manipulation and profit release in all its guises, either be it on the larger cycle or be it on the smaller cycle. Okay, so we've talked a bit about this box, this accumulation area. So what I'd like to cover now are the rules of this accumulation phase. So it's the rules that are contained within this box. What is actually going on? What's going to happen? So the rules of this this operation, again, from the market maker's perspective, keep this in mind all the time. The rules of this, it's got to be a covert operation. You can't blatantly say, okay, well, you know, through this period here, we're going to be accumulating buy orders. We can't release news that would intimate that. We can't show anything on the facade of the charts that are likely to show that. It's got to be a covert operation. Unless it's covert, we're not going to be able to exercise this. There's not going to be that element of surprise for the profit release. During this exercise, going through this period, this box period, there's got to be no discernible direction. We can't allow the outside market to have a perception that the market may be going in a particular direction. And we certainly have got no desire to create long-lasting beliefs of any particular direction. We want to create beliefs. The market makers want to create beliefs, but they want to create beliefs that's going the opposite way, so that when they're buying, others will be willing to sell them. But so there's no desire to create beliefs for a specific side. And I probably should have written that down there, but as long as I explain that, no desire to create beliefs in one particular way. And what's really desired through here is conflict and confusion is desired, because if people are confused, there's a bit of conflict, they'll start changing their minds. They'll think it's going to go up, they'll think it's going to go down. There'll be conflict going through their minds. They won't be comfortable about being in that. They don't like that conflict. You remember that right from the trading prison, right at the very when we started this. So conflict and confusion is desired through this period. So let's have a look at the perception and the reality of this accumulation phase. Okay, now perception and reality. The perception I'm associating here with the outside perception. That is, those people are looking at the charts, what they perceive, and it's what they perceive to be true of the market. And then the other side is the reality, which is the the market makers' business model. Now, the perception is that when the market's going through here, it's a congestion period. And you'll hear this banded around on the trading forums and all around, that the market's gone into congestion. Truism, nice sounding word. The word conveys what we see as a visual representation. We can see that there is congestion. You can't argue with that, say, oh, the market looks congested, looks confined on there. But at the outside perception, if we're sticking with that, we're sticking with congestion, and that's just it. The market's congested. The reality is of what is going on in this, what the market maker's business model, what is going on in this area. The reality is that this is an accumulation phase of either buys or sells for later profit. Okay, so this one is a what I call a tradingism, and basically it's accepted as true regardless of evidence. So we look at something and we see, and I'll give you an example of this. We might accept that this is a congestion area, and and we accept that as true regardless of evidence. Another one would be, which is a more important one, would be we could see that a market was starting to go up slightly through here, and we could visually see that, and we could accept that as true. In our minds, we could accept that as a true statement because we can physically see a price going up, and we accept that. We start to believe that, and we accept it regardless of the evidence of what is actually going on through here. This is accumulation phase, or we could say it's a profit release phase if we see the market going up. But I'm more talking about just generally the market going up a little bit, where we start to develop those beliefs. So a truism is something we accept as true regardless of the base fundamental evidence of the business of the market maker's business model. Now, and trading perception leads to a facade. So if we trade the perception, what is presented to us as an image, what we end up doing is trading facade rules. Now, what are facade rules? Facade rules, I only think about this, we've got the market maker's business model around here. In front of us here we've got our computer screens, and we're looking at the charts and the images and everything onto here. If we are looking at that computer screen, we are seeing this particular bar here, and this one here, and this one here, and this moving average line here, and this amount of volume here, and we are reading these elements on the front. We are trading the facade. We're trading something that is presented to us from the market maker's business model. Okay, so we're sort of trading this, but the real stuff is going on here. And what we end up doing is we end up creating facade rules. We end up saying, well, this bar's now gone higher than this bar, this one's down lower than this one closed higher than this one. So this shape means this. And this means that now I must trade, or now I must not trade. This means this fits my rules. This means this doesn't fit my rules. So we become totally hooked into the facade, and we're not trading that which is behind, which is the business maker. Sorry, I'll get that right in a minute. It's the market maker's business model. So now I want to talk just finally is really form and content. Let's bring it down nice and simple. Form and content. The chart, the facade, is the form that the market takes. The content is the business behind. The market maker's business behind is the content. It's the real stuff. That's the real deal. That is what we need to be trading. We observe the form as the form is presented to us, but the difference, what I'm saying to you, is that you're going to be learning how to read that form to read the content that is going on behind. Okay, where does this reality and the facade, where does this lead us? If we trade reality rules and we trade facade rules, really what we're going to be looking at, we're going to be looking at patterns. These patterns, I said about the higher bar here and the lower bar there, we're going to be looking at the patterns on the form that's presented to us, the facade, the form of the chart there. We're going to be likely to have bar names, and somebody gave me a book a few years ago, and on candle chart names, so you see a particular candle shape on a chart, and some of them are just wonderful. Morning cloud over, Hirami cross, engulfing bar down, and these are as if they're meant to mean something. And we can find these patterns and we can put them onto a 10-minute chart, and we see this beautiful pattern that's illustrated in the book. And so that's fine, that's great. Now what happens if we move to a 15-minute chart? That pattern's gone, but another pattern's there. And then you ask, well, what's going on? Which time frame do we trade now? Are we trading 10 minutes a day, the 15 minutes a day, the 20 minutes a day, the hour? What are we doing? What are we trading? And of course, none of these make any sense because these are the form that's presented to us. And when you think about it, what is the market? The market is not segmented. It's a constant stream of ever-changing ocean, if you like, a constant changing stream of information coming through in terms of prices. And we'll start to develop popular indicators. Just go to Google, type in what is the most popular moving average, and you'll find out whatever that is. I don't know what that is, but you'll find that. And so you start trading these popular indicators on there, and you'll be listening to truisms. Truisms, trade with the trend. The trend is your friend. The great things, they sound like they should have meaning, and in one respect there is an element of meaning in them, because when we talk of a trend, I'm talking of a profit release. The outside is talking of a trend. Think about that. Onto a profit release, trend, the same thing, but it's how I view the market. It's a profit release, it's not a trend. Trade the trend, that sort of thing. These are all truisms that traders can get hooked up on. And of course, this is the form. If we trade reality rules, the content, very simple. Very, very simple. We're going to be trading the market maker's business model of making money. We're simply going to be working out how are the market makers making money from what is being presented to us today on the chart. Once we understand that, we will make money. It's as simple as that. We don't have to have all these indicators, all this time frame. We don't have to do it. All we have to do is do this on here. Okay, now let's just explore a little deeper accumulation, what's going on there, because I think it's important that we fully understand this. And the way in which I want to do this on this one is to show you an example of a failed accumulation and a successful accumulation. Now, what we're talking about here, what you can imagine what would go on here. So as I've sort of anticipated here that the market's going into this accumulation phase, and an information release comes out here. What happens? The market takes off here, and the market goes up. You'll often have seen this. I've been looking at charts for some time. You'll see when the market goes sideways a little bit and then breaks off violently up or down. And invariably, what we see though is the market will come back to around this area and then start to go through, and then it will start to set off. What's occurred through this period here? News has come out, market's taken off. Problem is, the market makers have not been able to accumulate a significant number of buy orders through this period here, and so this has not been a high earning move for the market makers. Invariably what will happen is the price will come back down. It's like it goes on no substance. Price will come down often quite quickly to this through area here, where the process, the market maker's business model will start to kick in again, and we'll go through the accumulation phase again. Okay, now another thing is over here, I've drawn the right one, and I've put the time going through here, and a question mark. Be nice if I could say to you, right, okay, well this needs to be, this is no good because this is 5 minutes, and this is great because it's 45 minutes, and when you get to 45 minutes, that's going to be about where it's going to go. Now, that'd be nice, but that's a trading truism. That's a type of rule, because what we're doing then is, if you're doing that, you've defaulted to trading the facade. You're trading the form. You're not trading the content, because the only time this market will break from here is when the market makers have accumulated enough buy orders that they know they can sell into a pending rise. So this is not relative to time. It's only relative to time if you're looking at the facade of the chart. It's relative to the time it takes for the market makers to accumulate the correct number of buy orders that they're looking for to sell into the rise. Very important, just that little difference when we look at the time from the outside perspective and the time from the market maker's perspective. Okay, how truisms can affect the way we trade. Breakout truisms. Now this is what I taught you about placing the buy orders and the sell orders below on here. So this would be trading on the facade. This would be trading the form and not the content. The form is the chart we see through and through here. The form would be, it's congestion. We're looking for that breakout rule, so we put the buy above and the buyer below. So that looks all good. Looks great. We can test through that. That's it. That's how we'd make money. Let's now have a look at this truism in reality. Okay, the breakout reality. What we'll actually have here is position number 1. We've got our accumulation area running through here. You see here, we've placed our buy order up here, and we've got our sell order down here. The market goes through, the market breaks up, triggers our buy order, carries on up, we sell at a later price, and we've made money. That is a win situation. Okay. Now, number 2 scenario is where we have an accumulation period, just the same, accumulation phase running through here. We have a buy order here, there's one here, and the market goes up, triggers our buy order, which means we're long into the market, comes back down, stops us out, and then triggers a sell order. Okay, so we've now suffered a loss, and we may get a win from here. Either way, we have accepted losses at this point here. And the number 3 is when we see the market going through the accumulation period. We have a buy order, the market goes up, triggers our buy order. So we now think we're okay, that's great. We've got a stop down here, the market comes back down, stops us out, triggers a sell order. The market comes back up, stops us out on that one, and then the market breaks up on the buy order. And this can do this several times. Now, the truism is that this is a whipsaw. Okay, so double crosses, this is a whipsaw effect. That's a truism. On the chart, we see this whipsaw going through here. Now, what's happened? What is really going on as we're looking at this? What's going on behind that facade? This is yet another way of accumulating more orders for later on. This is manipulation. We're manipulating the market through this period here. Maybe some information got out here, but now by elongating this period going through here, we can see how this is being manipulated through there. And incidentally, this is a great trading model, and I'll show you how to do this. And I think actually on the next trade coming up that I'll be doing, I should be looking at this. I should be trying to figure this out for you here, so I can show you this on here. And generally, this will be around about a 45 pip type of range, around about there. That's a manipulation trade that'll come in on there, and that's what I want to do on one of the trades that's going to be coming up, so I can show you that as it were on there. Okay, let's have a look now over at stop loss orders. Now, stop loss orders, very important. They prevent us from losing huge amounts of money. For example, we wouldn't want to just buy a market without having a stop loss for an emergency period, for emergency position, because if the market starts to go against us, it could empty your trading account. So stop loss in that point perspective, we do need to use stop loss orders. There's another great way to use them in a minute, which we'll get to in a moment. But okay, so the perception and the reality. The perception is that they just stop losses, and there's part truth in that. They will prevent from unlimited losses. And for those of you who don't know about stop losses, that's going to be on the basic DVD. But basically, a market is going to, by putting a stop loss in, we are preventing an unlimited loss. The reality is they can actually be an accumulating device. Because if market makers deliberately move a market to trigger stop loss orders, even though they're not going to go in that direction ultimately, remember, by triggering, supposing that they're accumulating buy orders. Giving you a little example here, you've bought at this level. You've bought at this level here, and here is your stop order down here, stop loss, and that's to prevent you. The market is down. You're only going to lose this amount between here and here. You've bought down here, stop loss is underneath here. Now, if the market makers know the direction of the market and they want me to accumulating sell orders, then the market can be going up a little bit, driven back down, trigger that, and what happens is that you sell, sorry, they're accumulating buy orders, your stop becomes a sell order, market is driven down, picks up your sell order which is bought, and then the market gets into an up move. So stop losses can be used as an accumulation device as well. And they're also a keep playing device. Some slot machines, poker machines, one-armed bandits, they have payout rules. Payout rules are the facade. The reality is they keep playing rules. If a machine had payout rules and you just you just put your money in and it just took your money, never paid out, people wouldn't play these machines. Even though we know you can never win on these machines, because only people that win are the taxman and the machine owner, casino. That will not stop people playing these machines, and they even develop lucky wrist movements to affect the wheels inside on there. But if that machine never paid out, people wouldn't play. So the rules they have, the payout rules, are actually keep playing rules. It allows you to keep playing because it drip, drip, comes back. And about a 3-to-1 ratio of payout, not in your favour. Okay, so the way in which we need to be aware of this is by keeping our mind connected to the box. If we can keep connected to this box, we keep understanding and keep monitoring this box. Were they accumulating? Ask the question, were the market makers accumulating buy orders or were they accumulating sell orders? By keeping our mind connected to the box, we can utilize and work out where stops are being taken, and that will reveal to us information later on that we can use to quite devastating effect. Okay. So when you think about it, trading, it's a movie. That's what it is. It's got a beginning, it's got a middle, and it's got an end. And you know, it's a love movie. Let's take a standard love movie. You know, we sort of get an idea of the plot maybe from the DVD cover on there. The movie starts going through, and the plot starts to be revealed. You know, boy gets girl, girl gets boy. Everybody happy ever after. Uncover the plot. Invariably, what we get is that twist through the movie. 2/3 into the movie, we get that twist. All is lost. It's the end of the world, the relationship's not going to come off, this other girl's come in from wherever, everything's blown out of proportion, and we're left hanging what is going to happen. There's twist in there. And then eventually the twist is resolved, and then we get this very predictable outcome. Boy gets girl, girl gets boy, everybody's happy. Beginning, middle and end. And we can take this back to the market. We have the plot on here, we have the twist, which is the manipulation, and then we have the very, very predictable outcome of the profit release phase. Profit release phase is always going to happen, and that's the phase that we're after trading, but simply trading the market maker's business model. Okay, now what I want to do at the moment is just quickly return to the, and we're about must be coming up to the end of this DVD time-wise, getting onto the disc. I want to briefly return to the stop loss orders. The real power of the stop loss order. The stop loss order can be the harvesting, so it can be an extra accumulation of factor. Okay, very, very important. And the taking of harvesting of stops, it confirms, it tells us something. It tells us something very, very important. If we can spot stock taking, which is actually a harvesting exercise of accumulating more buys or accumulating sells, suddenly we are placed into an extremely powerful situation, because at that point, what the market makers have done to us by trading their model, they have revealed their hand. By taking those, accumulating that last few, they've revealed their hand, and now their move, which will be a default move, think about this, if they've accumulated buy orders to sell later, there can only be, or one way the market is going to go. It's going to go up. It's a default move. If they've accumulated sell orders, it's going to be a default move down, which means if we understand the market maker's business model, we attach ourselves to that model and we trade that model, when they go into their profit release phase, which is a default, we make money by default, and that is extremely powerful trading. Now, just had a camera shot there for a moment because I was looking for I was going through some old manual things that I'd written up that I wanted to sort of update with some fresh charts and things like that. And as I was going through them, now I know you can't see these charts from here, but I'm going to put them up big on the screen so you'll be able to see them. And I was going through these charts and I was looking at this particular chart here. You can see it's marked up chart number 1 on there, some yellow boxes on there. And what we'd seen is we've got the level at point at A, the level at B, and then we see that I'd highlighted where the stock take came down, drove the market down below points A and B, which was the accumulation, which was that last bit. It accumulated the last bit of stock, as it were. It was a stop taking exercise, and then you can see that the profit release phase, then the market takes off north. And then just as I was preparing up the DVD, which is the chart here now, and you can see this on your screen now, look at the similarities between the two. You can see the exact same process there, although I haven't marked them up A and B, the exact same process where they go through, and then the market goes into profit release phase. Okay, so what we can draw from this, we can see this exact same model repeated. Now, we could say it's a pattern, but we're not interested in the pattern because we want to understand what's going on. Where is their model? Where are they going to make money by default? And then we can join in. Now, those charts were months apart. Now, it doesn't mean you have to wait months for that to occur. That's happening on a daily basis, which we'll show about and I'll talk to you about as we go on. But anyway, that's pretty much the end of this stage of the lessons. So I'll catch up with you very soon.